Hi, everybody. So I have a couple of extra slides here, and so we're gonna mention some kind of interesting topics we may encounter with our K1s, but what we want to pretty much focus on for the majority of this presentation is issues that are unique to partnership K1s and getting that correctly on the tax return, issues that are unique to S corporation K1s, and we're even going to have a little refresher that we talked about our trust K1s, getting those on the Form 1040, and we are going to close with a little bit of K3 information. I went to do one of these presentations a couple of years ago, and I honestly didn't realize there were people that didn't realize if they got a K3, many people can completely ignore it. We were having people, attendees at the conference, that were struggling to enter all this information off the K3 and honestly didn't realize they may be able to completely ignore it for the majority of their clients. So we're going to talk about K3 briefly for that purpose. So one of the things we want to talk about generally with K1s today is just what is the general concept of a K1? The whole theory of a K1 is line one of most K1s, not counting the trust K1, but for a partnership or an S corporation or an LLC filing as either, the whole notion of line one on a K1 is what we generally think of as general operating income from a trade or business. And then line two, we're pretty familiar with, is rental real estate and then other rentals. And then it goes along right down the laundry list of items on the K1 that are generally items we'd find on the 1040. There's interest, there's dividends, there's capital gains, or maybe some recapture, depreciation recapture, all those fun things. 179 is separately stated. So when we talk about what's on a K1, generally, again, line one is our operating income or loss, generally, and all the other lines on the K1 are what they call separately stated income, losses, and deductions. And a common deduction on a K1 would be 179. That would be considered a deduction. Also, charity, for example, would be considered a separate deduction on a K1. And so that's the whole purpose of all those lines on the K1, is helping us get everything that passed from the entity through to the individual shareholder or partner to get it in the correct place on their 1040. And then as we're wrangling all these pieces of information we're seeing on a K1, we also now have some compliance issues on our 1040 Schedule E, page 2, where those K1 numbers are landing. And everything we have here that is in italics is basically from our instructions. And so what they want us to do now is, and if you're not familiar with this, years ago, and I mean years and years ago, I actually got a client who had a partnership, and he was on his third 1031 exchange on an apartment house. And he had, his negative capital account in this partnership was like more than $1 million. And I actually inherited him from a very large CPA firm in the Bay Area of California. And I remember saying, you can never sell this building as long as you live. I go, you're married, and nobody is selling this building until one of you passes away. Because they needed desperately the step up, okay? Because back when I started doing taxes a million years ago, we ignored. We did anything on that K1 went right on the 1040. Charity, foreign tax credit, losses. And the whole notion of losses are limited by basis and at risk and passive and all this fun stuff. We ignored all of that for decades, and nobody did anything. Every once in a while, there'd be a very important, like an audit of something, and we'd all hear about, ooh, somebody really got caught on that. But generally speaking, even large CPA firms, anything on the K1 went right on the 1040, even though these basis limitation rules and all these things have been around for a long time. So what we're noticing over the last probably decade is the IRS is kind of getting serious about it. They're kind of stomping their little foot and going, we mean it. You have to limit these things. Okay. And so that's why we're starting to see things like the S Corp 7203. And we're starting to see things like a checkbox now, where does your client have any limitations that may be applicable to a loss? And if they do, check this box. And so these are, the part in the italics is what we can see literally written on our Schedule E, page 2, for our 1040 client that says, if you're reporting a loss, or the taxpayer received a distribution, or they have disposed of any of their stock or LLC equity, if they're filing as an S corporation, or they've received a loan repayment from an S corporation, all these transactions that may have occurred during the year that require us to check a box saying basis computation is required. And then also, and we'll talk a little bit about at-risk in a minute, because I have kind of a shortcut at-risk issue that may help some people wrap their head around the difference between basis and at-risk. But in any event, so these are the compliance issues that come home to potentially cause a problem for us as the tax practitioner. Because now we're entering the K-1, we're filing the taxes on behalf of the taxpayer, and we're supposed to know these rules, and we're supposed to check these compliance check boxes, because our clients certainly are not aware of this. And then here's line 27 of our Schedule E, page 2, and look right there. And so, are you reporting any loss not allowed in a prior year due to at-risk or basis, or prior year unallowed loss from a passive activity that wasn't run through the 8582? Are you taking unreimbursed partnership expenses? If the answer is yes, we have to disclose that, okay? So these are some of the things that cause us exposure as the 1040 practitioner, okay? Now, so we've talked about how some of these items we may see on a K-1 will have the taxpayer's ability to deduct a loss or a deduction item, for example, 179 or a charitable contribution or something, in the current year may be limited. These are 4 limits that most of us are familiar with. And again, they've been around forever, but we're seeing more and more IRS focus on really mandating that people respect these limits and limit the losses and deductions that are landing on the tax return. Okay, so the limits and the orders in which they apply is, for partnerships and S corporations, the adjusted basis of either the partner's interest in the partnership, and we all, I was at Ryan's basis class earlier today, so for a partner it's generally their investment in the company plus their pro rata share of liabilities if they happen to be a general partner. Generally, a limited partner won't have any liabilities affecting their basis unless they've either guaranteed a loan or lent money to the partnership. And then for a shareholder, they're going to have their stock basis or their investment in the company, plus any loans the shareholder made directly to the corporation. I think we have this later in the, handout, but I want to mention this about shareholder basis right now, debt basis. One of the things that we notice when there's IRS exams on specific issues is we're sitting here trying to do a tax return and we're wrangling all these, like, what's the basis number? What is that in relation to the loss? What do I have to carry over? Et cetera, et cetera. A lot of times when there's an IRS exam, they can focus on 1 or 2 compliance matters and they can just throw all your calcs out. If you're found to, for example, you may have have this beautiful basis calculation, but if the information you're using that's establishing basis is out of compliance, your number is wrong. And one of the classic examples, and auditors, fortunately these types of audits are very rare, and with their resources getting cut substantially, who knows the next time we're going to see this type of an audit. But I have seen examiners go straight to compliance matters with basis. And a classic one is, you've lent money from one S corp to the other. That does not give the shareholder basis. And there's tax court cases on this. You can have somebody that owns 100% of both S corporations. And if one S corp needs some cash and they transfer it to the other S corp, that is no shareholder basis, not a penny. And you will lose that every time in an audit, and don't bother to go to court. You'll lose in court. So what our problem is, and again, our burden is to get the clients trained. Bob, you have got to transfer that money out of the S corp with the cash into your personal bank account, and 5 minutes later, transfer it over to the S corporation that needs the cash. Because no matter how much work I do establishing the dollar amount of your basis, If part of that basis is an inter-entity transfer, you don't have basis for that money. Period, you don't, and you will never win it. So in addition to understanding how we're calculating basis, we've got to understand what issues actually support our basis calculations from a compliance perspective. So our first limit is basis. The second is at risk, and I have a great little example to tie a bow around that. The third is passive loss limitations, and the fourth is the excess business loss limitations. The excess business loss limitations is the one that's going to challenge us the least. It's just strictly math. What is the total business losses on the tax return, depending on the filing status? Are you over the amount that's eligible? If you are, the software just carries it over for us. But where our compliance and our work comes into play is the first three limitations: basis, at risk, and passive. Okay, and so let me scoot to, okay. So the other thing we want to talk about is whenever we talk about what is someone's basis in their investment in, for example, a partnership or an S corporation, are we talking about inside basis or outside basis? We are talking specifically about outside basis, okay? And basis for S corp shareholders and partners are calculated differently, the biggest difference being that the liabilities for a general partner add their prorated share of the company liabilities add basis for a partner. They do not for a shareholder. Now, let's talk about responsibility of tracking basis. This is another kind of compliance thing, and you want to, again, we want to protect ourselves a tiny bit. It is absolutely positively not the S corp preparer or the partnership's preparer to track basis ever. If you receive a K-1 from a client of yours and they have this beautiful little basis worksheet attached, you are receiving that document as a courtesy. The preparer of a business return has absolutely zero obligation to give the K-1 recipient a basis worksheet and or for it, frankly, to be correct. The number one reason that it occurs is because there can be transactions that occur that the business tax preparer knows nothing about, literally knows nothing about, and never hits the books of the entity. So an example would be, let's say we have a fella that's one of three partners in a rental partnership, and he's getting very discouraged about how the properties are being managed. He's not getting along with his partners. He goes to hires an outside accountant. Maybe he goes to his 1040 practitioner who isn't the partnership practitioner, and he goes to an attorney. And he says, draw me up some paperwork. I want these fellas to buy me out. And by the way, I want to pay you to look at the books or pay you to review my K-1s or whatever. He may have incurred $10,000 or $20,000 of fees that have increased the basis of his investment in that partnership. The partnership tax preparer has no idea he's incurred these costs. Another one is, let's say someone buys out somebody from an S corp. So there's a couple of partners in an S corp, and one fella just sells his share to another S corp shareholder and he exits. There is no requirement that those two people discuss with anyone the buyout price, like none. The S corporation tax preparer does not need that information. It is nowhere on the S corporation books. Somebody sold their share of an S corp to a third party. That third party is now a shareholder, and their investment in that company is nowhere on the company books and may be completely unknown to the S corp practitioner. And then a third thing that is often unknown to the entity preparer might be something like, if I went out and financed, I took out, let's say, an equity loan on my home to invest in a partnership or invest in an S corporation, my 1040 practitioner probably knows my interest expense. But if my 1040 practitioner isn't doing that S corp tax return or that partnership tax return, they don't know my interest expense. And that doesn't hit the books anywhere, for example. So there's many reasons why it's the shareholder or partner's responsibility to track basis, not the entity preparer, okay? And one caution I would make as the entity preparer, I don't do this very often, a couple times a year. And by the way, I issue little basis statements with all the K-1s I issue. But if I am ever aware that there's a hostile situation, one of the partners, one of the shareholders has been cranky, it's been hard to get along with, is starting to complain about certain things, sometimes I will put literally a disclaimer with my basis worksheet that just says, I'm only taking responsibility for the current year transactions on this basis worksheet, and I am not taking any responsibility for your beginning or your ending basis on this worksheet. I have other times, I white them out. I'll give them the basis worksheet that shows all the components of the income and the expenses this year just to make it easier for their 1040 preparer to track basis, but I will sometimes literally white out the beginning and ending basis if I think there's any possibility of a hostile partner or shareholder. So again, we need to make sure we really understand our responsibility as the 1040 practitioner, but also some of our exposure as the business practitioner. Okay, now, I also am going to talk briefly about reconstructing basis. Both the 7203 and the partner basis worksheet, which is in the partner K-1 instructions. So this is a separate set of 1065 instructions that are separate from the instructions that come for the preparer of the 1065. Both the IRS partner basis worksheet and the 7203 now have lines and they were just added in the last couple of years, that say other increases to basis, other decreases to basis. So if you realize that, oh my goodness, you know what, I forgot to count something as basis last year, or I forgot, I have colleagues that do things like, if they don't do balance sheets, they never ever report the distributions, for example. And if you're not reporting distributions and someone's using your little handy dandy basis worksheet you gave them with their K-1, their basis is substantially overstated, because the distributions have not reduced basis in that example. So oftentimes, if I find, let's say I've onboarded a new client, or we just find that there's an error in basis that's been calculated, we don't amend for this, but there are specifically lines on the basis worksheets. So if you ever have to go back and reconstruct basis, or you're concerned that someone's basis is incorrect, when you're doing the next year's return, look at the 7203 or the partner basis worksheet, and literally other increases to basis, other decreases to basis. And that's where you can go ahead and make, rather than just changing the beginning basis and then wondering, you know, when you look at it 2 years later, what the heck happened, you go ahead and put it on the applicable line to fix the basis, and then you put a little memo there. And for example, now in my software, it'll let me put something in the little increase or decrease line, but there's no place to put a little memo. So I might want to, you know, hack that in some manner, or put a note in my permanent file. But just be aware, you don't have to amend if you find there's an error with basis, but what you do want to do is get it right. Now, the only time I would amend if I found that someone's basis was actually wrong is if I had severely, and I'm talking, you know, probably thousands of dollars, but if I had limited someone's loss deduction or some other 179 deduction because I felt their basis was too low and they needed to be limited, and now I realized that their basis was understated, I might amend for that person if it benefited them. To say, oh, look, I limited this $50,000 loss last year, and they really could have used it, but now I realize their basis last year was actually incorrect. So I might amend for that, but I'm not going to amend every time I may find a basis adjustment that I need to make on a client. So, and we have a little bit also of information in your handout about reconstructing basis. So, okay, so I'm going to go ahead and let me scoot a couple more slides and see if what I want to talk about it shows up. If not, then we'll scoot over. So again, we've already talked about the responsibility of tracking basis is 100% the 1040 practitioner. So it's really the shareholder or partner, so it falls to us. And then Ryan talked a little bit earlier today about what they call distributions in excess of basis. I don't like that term because the real rules for basis is simply this. It is distributions in excess of your beginning year basis, any additional investments in the company, or in the case of a partnership, any increase in partner liability that you're allowed to, up to the positive income items for the year. So it's not really your beginning or your ending basis. So the example is, let's say in a year that I get a K1 from, let's say, an S corporation that's got $10,000 on line one. We had a profit of $10,000, not a very good year. And let's say my basis started $2,000 at the top of my 7203. And let's say we unloaded some equipment that was a bad investment we were having a lot of trouble with. So now I've got a $40,000 capital loss on some asset we unloaded. This shareholder is permitted to take $12,000 of distributions without having a distribution in excess of basis. They're allowed to take the cash, their beginning basis for the year, and any positive income items for the year before you determine whether or not they've had a distribution in excess of basis. In this example, then if let's say they took out the whole $12,000 they had available, beginning basis $2,000, then the $10,000 profit on operations, then the entire $40,000 capital gain would be suspended until the next year. But that's how that works. So it's not really like, did they take more distributions to whatever their basis is at the end of the year? You're allowed to distribute up to any positive income items for the year and suspend all losses and deductions. Another way that we might want to say about basis would be the basis is never stated below zero, okay? Because it can be very confusing. And I'll tell you something else. If you're new to the 7203, in the old days when we were tracking, they finally got mad at us and we started actually tracking shareholder basis, our little Excel worksheets would go negative. And then when you reported your capital gains for distributions in excess of basis, then that added back. So that confused a lot of people when the 7203 came out, because you're sitting there going, wait a minute, how come I'm not increasing my basis? Because now they went and paid capital gains on that excess distribution. So that's the reason that you don't see the calculation on the 7203 adding what they paid capital gains to back to basis. And the reason is because the 7203 never permits you to go below zero. And the old basis worksheets, the Excel sheets would do that. Okay, so this slide I've already gone over. And by the way, and Ryan mentioned this earlier, most of our software, when we get to, for example, that 7203, and we have got distributions in excess of the basis, and if you think about the 7203, that's what it does. It takes beginning basis, any new capital contributions this year, then it adds all the positive income items there, and then the very next line is distributions before they get to non-deductible expenses and other items like that. And if we have distributions in excess of that basis about midway through part one of the 7203, then we are supposed to know as the practitioner that it's supposed to go over on the Schedule D. And again, most of our software doesn't do that. Now, I want to talk about at-risk a little bit. The reason Ryan had mentioned at-risk is most commonly an issue for partnerships is because a very common use of partnerships, frankly, is rental real estate. And rental real estate often have what is called qualified non-recourse financing. And qualified non-recourse financing is any loan on a piece of real estate if that real estate is used by that entity. That's called qualified non-recourse. So even though it's a non-recourse loan, it gives a partner basis, similar to what we talk about in investments or tax basis. A couple of things between recourse and non-recourse. A non-recourse debt just means that it's a debt that if the only action the lender can take is to repossess the construction truck, repossess the equipment, repossess any asset that's securing the debt, and if the property that is taken back by the lender cannot satisfy the rest of the loan, the lender cannot go after the partnership or the S corporation to pay the difference. That's all that is, okay? And so that's specifically called a non-recourse loan. And oftentimes, if you've got a partnership or an S corporation and they've just bought a new vehicle or they bought a piece of equipment, if you ask for the contract for the equipment, a lot of times it'll say right on the loan or right on the purchase contract, non-recourse. But that's the difference between a recourse and a non-recourse. A recourse would be something like a credit card bill. If the S corporation runs up some business expenses and then they default on the bill, that lender for that credit card company can look to that S corporation to pay this bill, for example. So that just gives you an idea of what recourse and non-recourse is. Most of the non-recourse loans we would see for a partnership or an S corporation would be something like a vehicle loan or an equipment loan, generally speaking. Or in the case of a partnership, we may have the qualified non-recourse, which would be the real estate loans. Now, here is a quick little illustration between basis and at risk. Let's say that our favorite nephew, I love nephews, our favorite nephew finds this great deal on a car wash. He goes to his uncle, the one with all the money, and he says, hey, let's go in 50-50 on this car wash, and I'll run it, and we'll be 50-50 partners in this car wash. And the uncle goes, great, I'll do it. So the uncle puts up $100,000, and they buy the car wash. They're 50-50 owners. The nephew has no basis at all because he did not put in one dime. The uncle has basis because he put in $100,000. And by the way, if we loop in our third limit, what if the car wash is in Arizona and the uncle's golfing in Florida? What does the uncle probably got? He's also probably got a passive loss on all of that equipment he wants to bonus, right? So that one little illustration of this car wash between an uncle and a nephew gives us a situation where we know the nephew has no basis. He didn't put up a dime, even though he owns 50% of this car wash. The uncle owns 50% of the car wash. He's got $100,000 of basis. Now, what if part of the deal, the nephew says, I talked to my wife, and if this goes belly up, if this turns out to be a bad deal, I'm going to pull $100,000 out of my 401k and I'm going to pay you back. But I'd rather leave my retirement where it belongs, and hopefully this is a great deal for both of us. Guess who's not at risk? The uncle is not at risk because he has been promised to be made whole in the event that there is a loss. So that is a down and dirty. The nephew has no basis because he didn't put up any money. The uncle's put up $100,000. He's got basis, but he's not only not at risk because he's been promised to be reimbursed, and it could be a very informal agreement, and we already are pretty sure the uncle has a passive problem too because he's not materially participating. So now, is the uncle going to tell you that the nephew promised him? Probably not. You will probably just say, hey, here's our purchase contract for the car wash, and by the way, that $100,000, that's all my money, Jane. Okay, that's fine. I may not even ask him, did your nephew promise to pay you back? I don't know. But that is a quick example. Now, another one that is common, that I won't say it's common, but another one that, again, this could be something that, for example, would an IRS auditor ever figured out the nephew promised that? No. But here's where we may have a problem. Let's say that we've got a couple that own let's say they own a big landscaping firm or construction firm, and they want a grown son or son-in-law to go ahead and invest in the business and become an owner. If he borrows the money from another shareholder to invest in that S corporation, that is a flat-out definition of you're not at risk. And that's for a partnership or an S corp. So again, that's something that an auditor can trip to. You've got a fellow that's been filing a 1040 for 10 years and never's made a dime over $50,000 a year. How did he come up with the $80,000 he used to buy into his in-laws construction firm? Oh, I borrowed it from my in-laws. I took a note. Guess what? He is not at risk. He's got an $80,000 investment to buy in to his in-laws construction firm or whatever it is, but he is not at risk because he borrowed from another shareholder. So those are, and again, if we just keep a couple of basic little compliance issues in mind that might trip us up, then we're probably going to be good to go as we're just trying to wrangle, is there enough basis or is there not enough basis? Because those are the most common things we're going to run into, right? It's just going to be basis. And so then here, I've got some of basically the regs on at-risk, which I'm going to go ahead and scoot along through because we did our little simple example. But here, guarantees, stop-loss agreements, similar arrangements, those types of things. And then we've got the description of non-recourse financing, and then qualified non-recourse financing. So we're going to scoot along through those. And then here we go. There are some other at-risk considerations. One is related party borrowing. For example, if the son-in-law is married to the daughter and her daughter is the grown child of the in-laws, you've got related party issues. And by the way, Pub 925 has a nice discussion of at-risk if you want some more information on that, and also the instructions for 6198. Now let's talk about 6198 because this is painful, horrible, and awful. When I started diving into this, I couldn't believe it because, we use our software, right? And so if we are putting in our K1 and we know there's a little basis issue, we go ahead and check in our software. This might not all be at risk. And by the way, the 6198's been around forever, and the 7203 is new. So what we're finding is that most of our 1040 tax software drives limited losses to Schedule E through the 6198. It's not using our 7203. And if you really want to ruin your day, do an S Corp where you've painstakingly done this beautiful 7203 with this suspended charity and some suspended 179 and some suspended loss or whatever it is, and then you turn around and you use the 6198 because that's what your software wants to use to limit it on the Schedule E, you're going to find your carryovers are different on your 6198 and your 7203. And by the way, I have notified the IRS of this a couple times and they're ghosting me. But the reason that they're coming out different, and it's not a huge amount of money, but the reason they are coming out different is the 6198 is basically written with partnership rules. And there are different carryover and different basis rules for S Corps. And one of the things we're going to talk to, if we can get over there, about what's unique about S Corp K1s, for example, is the very front of the 72, the very first part of the 7203 says, does this taxpayer make an election under some code section I can't remember? Check this box, yes or no. Well, what that election is talking about is, specifically for an S Corp, this is not true for a partnership, specifically for an S Corp, remember we did our beginning basis, then we did any investments, all our positive income, less our distributions, less our non-deductible expenses, and then we get down to, is there any 179 or losses or charity or foreign tax credit we want to take? We can make an election to flip it and say, I'm willing to carry over my non-deductible expenses if you let me take my losses first. Now, that seems kind of like big deal. Who cares if we're talking about something like 50% meals? But think about, for example, a restaurant that has a very large, for example, tips credit. That tips credit could create a $20,000 or $30,000 non-deductible payroll tax expense on that 7203. Now you're sitting there going, would some of my restaurant clients kind of benefit from getting that $30,000 non-deductible expense out of there so we could take a little more of the restaurant loss this year? Let's say they remodeled this year, bought a lot of equipment, and they've got a nice big loss from bonus depreciation or something. So that to be able to make that election to say, I want to take my losses before I take my non-deductible expenses, 6198 doesn't support that, even though all of our software is using the 6198 to drive the loss limitations to Schedule E. So it's an interesting thing. And also, if you try to go read the instructions for 6198, it literally gets down to the bottom line of 6198, and it says, yeah, you may have to allocate some of these carryover things if you're out of basis. And not only do I think they need to do a lot better job of just explaining what they're talking about for just allocating partner suspended categories of losses, But they also need to explain the difference between how they expect the 6198 to work for the S Corp versus the partnership. And I keep going in there making all my good, we need this, and they totally ghost me. And so we'll see. But for now, most of us are using the 6198 in our software to drive a loss limitation to our Schedule E. So let's at least take a minute and just understand how the 6198 works, because this is actually kind of interesting. So the first part of the 6198 is all the activity on the K1 this year. And some are obvious, like line 1 is ordinary income, which we expect. But then they kind of smush a lot of other things that may be on a K1 to these other lines, 2 through 4, okay, or even 2 through 5. And if the client for this one K1 activity, this one K1 investment, if they had suspended losses from the previous year, your software is also combining any previous losses with the current year K1 activity. And that's what's landing on lines 1 through 5 in your software. And that's part 1. Now part 2, this is where things get interesting. This is what they call the simplified computation of amount at risk. Line 6, which is the first line of part 2, actually starts with adjusted basis, not at risk amount. It starts with the adjusted basis at the beginning of the year for this K1 activity, okay? And it says do not enter less than 0. And then what it has is increases for the year and decreases for the year. So just to give you an example of how this would be filled out, if we use our $2,000 and then our $10,000 of profits S Corp example, so my line 6 here would be the same line as in theory on my 7203, my beginning basis, because it's tax basis, not at risk, even though this is an at-risk form. Line 6 is my beginning tax basis. So I'm going to put 2,000 on line 6, and then let's say that I didn't, let's say this year, and by the way, why don't we go ahead and use our son-in-law? So on line 6, we're going to put 0 because he bought in this year, okay? And then, so his beginning basis is 0, and then line 7, what's his increase? His $80,000 investment. However, I get down to line 9, and I happen to know that he borrowed the $80,000 from shareholders. So on line 9, I've now got to back out that $80,000 investment because it's not at risk. So that's what part 2 of the 6198 does, and most of us are not aware of that at all. For one thing, a lot of us aren't even aware if we have an at-risk issue, and frankly, they're not that common. But then number 2, we're not aware if we do have an at-risk issue that we were supposed to enter something on line 9 to convert the basis from regular basis to at-risk, right? So in any event, and then we get down to the line 10B, which is what then our software is going to use to permit any losses or charitable or 179 on our Schedule E. So that's how 6198 is operating in your tax software. Part 3 of 6198, oh, and this just walks through the lines I already talked about, so we'll scoot through that. And it talks about, and so again, so we arrive at line 10A and B, which is the at-risk, I call it at-risk basis, Ryan likes to call it at-risk amount at the end of the year, okay? And so in theory, this is what then, whether we have an at-risk problem or not, this is going to drive any suspended, any limited losses to our Schedule E based on how we fill out the 6198 in our software. Part 3 of 6198 is largely ignored. It's obsolete for some old transition rules. And then part 4, where it shows the deductible loss and the amount of basis determined to be at risk. And then part 4 is also going to, in most of our software, talk about what's limited and what's carried over. And that's where if you compare your 7203 in your software with your 6198, you're going to find different numbers for an S Corp. And it's a little bit challenging. But in any event, okay, so I just want to make you aware of how our tax software is handling these issues and some of the little caution items we want to keep a lookout for. So we also talked about the third loss limitation, which is our active or passive shareholders or partners. And I've got a fair amount of information in your handout on specifically active or passive. I'll tell you one thing. A lot of people ask me, if there's a married couple, should we do 2K1s? If one of the spouses is not actively working in the business, I wouldn't do 2K1s. I would do a joint K1. Either do it just for the spouse that's actually actively working in the business, or do it joint with the two taxpayers. Because I've seen situations where they've started an S corporation and one spouse owns 80%, the other spouse owns 20%, and because the other spouse isn't working in the business at all, their actual losses that they would be eligible to deduct keep getting suspended due to passive, you see, because that one spouse was it. Yes?
Would that cause an issue because the K1 only has one Social Security number?
No. You can do joint K1s all day long. Yeah, all day. And I would put well, you don't even really need to do the like, let's say you've got the husband is the primary on the 1040, and this entity is owned 100% by the spouse. You put the spouse's Social Security number on there. And so we have some information in your handout, which I'm not going to do a deep dive on this, specifically the material participation rules. And this would come into play for example, our uncle that lives in Florida, but he's invested in, for example, a car wash, right, in Arizona, that we would want to be careful about ideas like that. And then we have the notion of the passive or active for partners. One of the biggest things of exposure that we have for partners and partnerships, honestly, isn't really active or passive, because a lot of partnerships are rental real estate, and unless the partner meets the real estate professional criteria, it's automatically passive anyway, even if they materially participate. So that's not the issue. Our biggest exposure as practitioners is the SE tax on partnerships. Again, if it's rental activity, real estate rental activity, it doesn't matter if they materially participate, we don't have an SE tax problem. But what is landing in a lot of court cases these days are people that are actively participating in regular operating businesses, and they don't want to pay any SE tax. So they just tell the practitioner, oh, I'm a limited partner, but they're actually running the business or doing material items that they shouldn't be doing as a limited partner. And those people, that's another classic example where the auditor doesn't have to come in and fiddle with anybody's math. They just come in and go, what does this person do for the entity? Well, guess what? They're not limited. They owe SE tax at times 3 years that we're auditing. And so that's a little bit of exposure for us on partners. Now, we do have a type of partnership that is called an investment partnership, and it's basically what you'd have like a stock trading club or something like that. And then sometimes they're a little more formally organized, but sometimes it could just be an informal group of people that get together. But if their business is trading stocks and bonds and those other securities, that is by statute not considered passive, okay? And we will often see on the K1, someone will put a memo or a notice on that K1 that will specifically say, see the partner footnotes, and the K1 may literally say on it, not subject to passive activity loss limitations. And it's specifically because it's an investment partnership. So if you see that and you're worried about, well, wait a minute, this says it's not subject to the passive activity loss limitations, but I know for a fact my client doesn't materially participate in it, that's okay. That's why those notes are on that K1, so just be aware of those. Now, we also have some information in your handout specifically about if the partner, or I hate to say S-Corp shareholder because I hate real estate and corporations probably more than Ryan does, but real estate in S corporations or even C corporations is fraught with peril, like horribly fraught with peril. But in any event, if we've got a general partner in a partnership that, and there's rental activity in that partnership, and the general partner qualifies as a real estate professional, they may be eligible to group one or more of the rental properties in that partnership with their regular real estate pro grouping to take advantage of potentially more losses than maybe some of their other investor partners might be able to in those, be able to take advantage of in that partnership. And I had a real estate pro audited recently, a couple of years ago, and the client's in the Bay Area, the auditor was in the Bay Area, and I'm down in San Diego, and I'm like, you don't want me to come up there, do you? And the auditor went, oh, I only want one thing. He goes, I want the grouping election. And I'm like, okay. And he said, I know your guy's a real estate guy. I could see his Schedule C. He's making a lot of money in real estate. He goes, you got a big loss in an Arizona apartment house, and you've got a big loss in some Southern California real estate. You get me the grouping election, the audit's done. So literally, that's what would happen with if we have a client that qualifies as a real estate professional, and they're investing in a real estate partnership, if that's giving off losses that might, for the other partners, be limited by the $25,000, passive loss exception based on their AGI or something, our clients can group their investment in that partnership if it benefits them. And what that permits them to do is to take their investment in an activity that they may not be materially participating in that specific activity, but they group it with their other rental activity, and now they meet the material participation rules. And by the way, we also have in our handout, you can also aggregate for QBI, something in an S corporation or something in a partnership. Your investment in one of those entities can also be grouped for QBI purposes to take advantage of wages and the UBIA, the depreciable assets. Okay, so then we have some information here. If we have a limited partner that is really trying to take advantage of the real estate professional losses, they have a much smaller, they only have 3 opportunities to be able to meet that for a limited partner. And again, I have that in your handout. The 7217 is a brand new form that came out, and I believe this came out in 24. And this caused a great deal of pain and agony because everybody's like, oh my goodness, we have another form we have to worry about. I have some very good news about this form. There's only 2 codes on the Partnership K1 that in any way affect this form. And so if your client, and I can't even remember what the codes are, they're on the next slide. But what this form does, the 7217, and this is something Ryan mentioned very briefly earlier today, that if somebody gets assets, gets a property of a partnership distributed out to them, then not only is the partnership required to declare and file a statement that says, this was our basis in this is the accumulated depreciation on this asset, and this is what's been distributed out to the partner, but then the partner that receives the asset, and which that's us now, that's the 1040 preparer, is now required to file Form 7217 with that partner's 1040 in the year they get that asset. Now, let me tell you what is crazy about this form. And there are so many instances with IRS compliance that what they ask you to do is almost like, how in the heck am I going to do that? One of my classic examples is what Ryan talked about earlier, the 754 election. It's all well and good to say, oh, the partnership agrees to do the 754 election for the new partner that inherited the other partner's interest, but I, as the partnership practitioner, I have no idea how to get the value of that property. I have to work with the executor or the trustee or somebody to go get the appraisal of the assets and then give me the appraisal value, et cetera, et cetera. The 7217 literally wants you, the 1040 practitioner, to be able to declare your partner got a piece of real estate from the partnership on June 5th. What was their basis on that day? What was their exact basis on that day? What don't I know? I don't have any idea what was the profit and loss up to June 5th in that partnership for my partner's 1/3%. I don't have any idea. And how do you like this? What was my partner's pro rata share of liabilities on June 5th, right? The amount of information they want from the 1040 practitioner to prepare the 7217 is ridiculous. It's absolutely absurd. And I've actually written a 2-hour course on this. I actually lent my course to AJ Reynolds because he's like, I can't write this. I'm like, take mine. And but the kicker is, we literally sat around debating this, going, okay, well, if I got property, and by the way, when are we filling this out? We're filling it out next spring, right? We're not filling this out the day they get the property or the month they get the property. So I'm like, well, would I take a partnership K1 and say, well, if they got it June 5th, am I going to just maybe take 5/7 of the profit for the year on the K1 and say that was their income up, that was their prorated share of their income up to that date, 5/7? And then how do I want to try to estimate what the liabilities were that date? Now, if the partnership bookkeeper or accountant is a friendly, cooperative person, or the partnership tax practitioner is also doing the QuickBooks, we might say, hey, can I get a June 5th balance sheet and P&L, right, year to date? That might help me. But what if they enter all the depreciation, for example, at the end of the year or something? What if they make some tax planning moves at the end of the year that really, weren't, that should affect the June 5th number, but don't? So anyway, this is a crazy form, and it's falling to us as the 1040 practitioner. Here's our good news. Oh yeah, it was brand new in 24. We only have an obligation to file this form if somebody gets a partnership K1, box 19 with code B or C. And so if you get a K1 with box 19, and again, it's only a 1065 K1, with box B or C, and that's all you get as a K1, you need to go running back to the client and go, I know they gave you more paperwork. Just like poor Shannon and her supplemental stock option reports, right? We need some information here. But what they're not prepared to give you is what was the year-to-date, your client's share of the year-to-date profits on June 5th. Believe me, the 1065 practitioner is not prepared to give you that number. You may want to cajole them and ask them for that number, but they're not prepared to give it to you. Okay, and by the way, the 1065 practitioner may not be doing the books. They may just have a calendar year P&L and balance sheet, right? Okay, and so then here's some more information of how we are going to worry and fret about filling this form, but we only have to worry about it in the case of a code B or a code C. Now, and I'm gonna walk through this briefly because I want to get to the good stuff that I always run out of time getting to. So what we have in the next couple of slides is, as the 1065, and this would be for an S corp or a partnership, is if there's more than one rental property. Let's say you have an S corporation, and let's say it's a veterinary clinic, and let's say they're selling pet food and they're providing veterinary services. Those would be examples where the practitioner of the entity should be providing us, for example, QBI information and passive loss information on rental property. And for a partnership, they may be telling us what is the qualified recourse liability on these different rental activities in a partnership. So what we have here in your handout on the next couple slides is some of the additional detailed information that, as the 1040 practitioner, we can expect to get accompanying a K1 that may have complicated reporting on it. Because what's on our K1 is just a summary of that partner or shareholders. If there's 3 rental properties in a partnership, all we're going to find on the K1 line 2 is that partner's pro rata share of that activity. We need the details of each rental activity. Now, I want to talk about this. The first time I saw this, I almost had a heart attack. And I was doing the partnership return. This was many years ago. I had these clients that had this apartment building for ages, and they had a $400,000 loan on it. And I go to do the tax return the next year. I didn't do the bookkeeping. And now they have a $1.2 million loan. And I knew organically that they couldn't possibly deduct all that interest, but I know what the heck to do about it. I had to go look it up and go, what am I doing? And so sure enough, if you ever get a K1 from an S corporation or a partnership, and it's got code AC, it means that they're reporting non-deductible interest for your client. And then what you say to your client is, hey, it looks like you're getting allocated, $28,000 of non-deductible partnership interest. Oh yeah, we refinanced, we took a lot of cash out. Yeah, that's nice, what'd you do with the money, right? So if one partner says, oh, well, I already gave you the purchase escrow, my wife and I want that new rental property. Goody. So for the rest of the time I get the K1 from this partnership for this client, every time I see this his share of the non-deductible interest, that 28,000, go down a little bit each year, I get to say that goes right over his Schedule E for his new property, because the client told me that he took that extra cash out of the partnership and he invested it in another rental property, okay? But what if the other client says, oh, we bought a sailboat, we're having a blast. That's nice. So for the rest of the time, you get that partnership K1 with that $28,000 of non-deductible partnership interest for his share of non-deductible interest, you're going to ignore it because he did not use it for a bona fide business or investment purpose. So that's what we have to be careful, is if we see a Schedule K1, and by the way, K1s are already confusing enough when we get them. When do we get them? We get them all, October 12th, whatever. And, but when we might also look for that code. Somebody gets their little $60,000 distributions every year, and this year they got $600,000 distributions, or this year they got $400,000. You might go, hold it, you took a lot of money out this year. Let me go see if there's any information I need to worry about, because in that example, now what if that partnership that pulled the extra 800 grand out of that big apartment building? What if they put it in the bank and they went and bought more property for that partnership? Great. So that they're going to trace that, the new $800,000 loan that they took out on the original building, $400,000 paid off the original loan, that stays allocated to the original building. And if they take that $800,000 and they purchased one or more other properties, again, in our little statements we get every year that show the different rental activities, they're going to now allocate that portion of the interest that goes to the other rental activities. And there's all kinds of special elections you can make, and you can put that money in the bank and leave it in the partnership, and they may not find another property for 5 years. That's okay, as long as they didn't distribute it and then the partners use it for something personal. And again, there are some special elections for that, but I just want to make you aware if you see those codes. We also have a fair amount of interest here on the 163J business interest limitation. And what I want to make you aware of for this, for shareholders and partners, is the codes for the interest limitation from an entity is different for a partner or a shareholder. So if we have a partnership K1, that's box 20 code N, that just tells us the interest, that expense that's already been included in some other line of the K1. So it could be line 1, line 2. And you will notice, by the way, because they keep revising the partnership basis worksheet in the IRS instructions, they've now got a special line for specifically these codes, where this interest, whether or not it's ultimately deductible by our clients, and most of our clients don't have the interest limitation, but you have to subtract it as a non-deductible expense even if they don't get the benefit for it. But what I wanted to point out that's different for partnership versus S Corp is, if we get a box 13 code K, that creates a filing requirement for the 8990 for that 1040 client, whether or not they're normally subject to the 163J limitations. So keep an eye on that. If the partnership issues box 13 code K, and then for the exact same thing for an S Corp, which is box 17 code AA, they only have to do it if they're already required to file the 8990 for the 163J limitation. So that's a difference between those two K1s, and we have a little more information about that in your handout. This I just mentioned just from regular compliance standpoint. Don't get into a situation where the entity wants to deduct some interest expense, but that shareholder or partner or friend or family member who lent the money isn't reporting the income that year. So again, that's another compliance thing that IRS auditors love. Gee, you deducted this $20,000 of interest, and it was a loan from a partner or shareholder. Did they report the income? So we just need to be careful about that. Now, one of the things we want to talk about is how we're going to deduct interest that the taxpayer has incurred to invest in a partnership or an S corporation, or sometimes to even lend money to a partnership or an S corporation. Remember how we said earlier that a loan, an S corporation loan between entities, doesn't create basis. I've had situations where clients their S corporation doesn't really, have a credit report or have any decent assets. So the shareholder will take out a loan for the S corp and guarantee the loan. That doesn't give him basis. The shareholder should have taken the loan out personally and then lent the money to the S corp. And so when we do it the right way, and by the way, this one client, it took me forever to get him trained. And now I don't care when he bothers me, what time of day or night. If he calls and asks me tell me again what I have to do, I drop everything and go, remember, it's got to go from you to the thing. Because it took me so long to get him trained, I don't want to be mean when he interrupts me on Friday night to ask me the transfer question again. But anyway, so here's what we want to know about this. If we have a client that has borrowed money to either start an S corporation, invest in an S corp, lend some money to their S corp, or a partnership, how we write that off is based on basically the underlying assets of the entity. And it also, here's our IRS notice 8935. So bottom line is, if I borrow money to, let's say, invest in an S corp that's a restaurant or to start a restaurant, the interest I pay on that, because the underlying assets of this S corporation are basically the operating assets of a restaurant. I can deduct that interest expense right on my Schedule E if I materially participate. And I can deduct that every year. You could capitalize it if you wanted to with your basis, but you're not required to, your basis of your S corp. However, let's say, for example, that I borrowed money and I'm incurring bona fide deductible interest expense, but I'm using that money to invest in a real estate partnership, and the real estate partnership is, subject to the passive loss regulations. So then that interest would have to be reported on the Schedule E and be subject to the same passive loss limitations that the regular rental activity would be. So that's what we have to do. If someone advises us that they have interest expense based on investing in an activity, we have to know what's the underlying operations of the activity. Does our client materially participate? Because sometimes it actually goes over on 4952 and gets reported on Schedule A. So that's how we determine where they can deduct their interest that they use to invest in, or sometimes, in some cases, loan to an entity. So I'm going to scoot through these, and then we already mentioned it might be passive interest expense. And if they've got some suspended passive interest, and based on the passive loss rules, and they may be eligible for the $25,000 exception to those passive loss rules for that interest deduction in some years. Also, if they dispose of their investment in the entity, it frees up any suspended interest expense. So just keep those rules in mind. Now, we also want to talk about shareholders and partners owning multiple interests in an entity. So generally, this is not an issue for partnerships. Whatever you ended up owning, whatever your pro rata share was during different times of the year, that's just the aggregate of what you're going to report that year for various times. It's very common for, let's say there's 3 people in a partnership and the building needs a new roof, and they do a capital call, and only one of the partners has the cash. So July 10th, he just went from 33 1/3 to 49%, let's say. So the practitioner is going to figure out what was his share up to then based on when his ownership percentage changed, because that was the part of the partnership agreement that if someone has to put in additional funds for the entity, then we'll adjust our ownership. S corps don't work that way. And one of the things we have to keep in mind with S corps are literally when you acquire the interest. There's no average for the rest of the year or anything like that. And a common one would be, let's say uncle and nephew, they own their S corp car wash, and the uncle passes away and the nephew inherits the uncle's share, okay? Nephew now owns 100% in all subsequent years. He's only going to get 1K1. We, as the 1040 practitioner, are supposed to be tracking basis for 2 blocks of stock. His original stock when he owned 50%, and then the stock he inherits 5 years later from the uncle. And something else I yell at the IRS about all the time, and they're ignoring me on this one too, is the way the 7203 is structured, if you think about the shareholder loan basis where you can do up to 3 columns, and if they have an extra shareholder loan, you can even get a new form and start more loans. I wish the IRS would take the part 1 of the 7203 and at least make 2 columns for 2 different blocks of stock. Because until they actually design the form that way, our software is not going to support it because they're not going to do the work. And so that's why in your software you can put on all the loans you need, but you can only do 1 block of stock. So if we want to do, and by the way, you're going to find this if you're not familiar with it, most of our TAC 1040 software will only do 1 7203 per K1. And in, for example, Nephew's case, for the rest of the time he owns that S corporation with a car wash, he's literally got 2 blocks of stock. And where that becomes very painful is things like losses and deductions. If you run out of basis, like he's going to have potentially, if it's a successful car wash, he's going to have a nice little step up on the stock he inherits from the uncle, right? And so if he ends up using up losses, uses up his original basis, he can take extra losses with his extra basis from the inherited block, not for distributions. Distributions are, you run out of basis over here, tough. And so that's one of the things that I actually don't like about the code. But as a 1040 practitioner, we are supposed to be keeping a different 7203 part 1 for every block of stock they own. And that, again, becomes painful because if you're doing it right and you're in compliance, then you've got to do a PDF and like attach it to an e-file or something. What I've seen some people do, which is kind of handy, is they kind of have a worksheet for both blocks, and then they just go ahead and merge them on 17203 because they just don't want to mess with attaching the PDF and everything. And again, it's not that common, but it happens. People buy out shareholders, people inherit, an interest in an S corp, and then they end up with what we call 2 blocks of stock. So that is specifically multiple investments. We also have some information in your handout specifically on the 179 expense for pass-throughs. That's going to be for a partnership, the K1 box 12 or an S corp box 11. And basically, oftentimes we run into the 179 problems with state conformity more than we do for federal, especially now with OBA, where they've drastically increased the 179 limits. We're generally not going to have that problem. But what we have here and in your handout is if we have 179 that is limited, I want to make sure I get this right. Do I have the right slide? Yes, here we go. So 179 that's limited by the maximum deduction, which we'll rarely see for federal purposes, but we may for state, or it's limited by exceeding the maximum threshold of assets, those may not be carried over. But 179 that's limited due to the business income limitation, for example, those do carry over. And so we need to be aware of those when they land on 179s. Also, we mentioned earlier separately stated items. The reason we are seeing assets that are disposed of by a pass-through entity that are basically, they're not running the 4797 through the entity, they're separately stating those disposed of assets as a statement on the K1. And because it seems kind of crazy at the federal level, almost all of our clients would never ever meet the 179 limit with most of the companies we deal with. But for example, in California, the 179 limit is $25,000. And if somebody's involved in, for example, 2 different entities and they have 2 different practitioners, you may actually end up with, in California, more than $25,000 of 179 on K1s for the same taxpayer in the same year. And that they lose some of that 179, they can never take it, right? And so that's why when those assets that have that underlying 179 are ultimately disposed of, they're separately stated on the K1, because we may say, oh, they acquired this asset in the year that Bob's 2 K1s from his 2 pass-through entities, his 179 in California totaled $30,000. And so he missed an entire benefit of $5,000 of 179. So when that asset gets disposed of, he can reduce his recapture by the amount he never got a benefit from. More stuff we have to keep track of. But that's why 179 property dispositions are separately stated on K1s. Now, I want to scoot over to, let's talk about PTET, and then I want to scoot over to our S-Corps, different from our partnerships. If you're not aware of this, the OBA that just got passed, it passed Congress for House of Representatives, and then it passed Senate. One of the two, I forget which one, I think it was the House of Representatives, passed a law that didn't make it that said, we want PTET to be separately stated based on the components of income. So if you're not familiar with this now, and I believe New York has the pass-through entity tax credit, I think even New York City does, has the pass-through entity tax election. How that is stated, and the only guidance we've gotten from the Internal Revenue Service since this was implemented was Notice 2020-75, and it specifically says in that notice, any, and I'll say New York, any New York tax paid on behalf of the shareholder or the partner should be deducted on line 1 of the K-1 only, even if it creates a negative. And where I'm going with this is, and I see these entities done wrong all the time because it sounds unintuitive, so people kind of try to hack it. But for example, and if you don't know this, if they ever put out a notice or a rev proc or anything, there's always at least 2 phone numbers in that document, and it's always on the last page. If you've got a $189 document from the IRS, the last page is going to have phone numbers of somebody in the department that released that document, and they will pick up the phone. So when this first started happening, I kept getting a hold of them, and they actually did talk to me, and I said, okay, here's my example. State of California, 9%. Somebody's got a $200,000 rental gain on line 2, passive rental income, line 2, 200 grand. That's this partner share. And his share of PTET at 9% is 18 grand. You're saying you want a negative line 1, 18 grand, and you want the 200 grand rental. And he goes, yep, that's the notice. Because look what the line 1 of PTET lets us do. W-2 wages, retirement income, any other operating income. We're not required to use that pass-through elective deduction against the rental income. And what if instead of $200,000 rental income, what if it was $100,000 very favorable long-term capital gain? I get to use that $18,000 or whatever 9% of $36,000 line 1 against any other income in the tax return, and I get to keep 100% of my $40,000, for example, long-term capital gain. It's crazy. Or 100,000, whatever the math was. But you see my point? And a lot of people don't understand that issue with the pass-through entity tax election, where the IRS wants that to land on the K-1. They want it on line 1. Now, they tried to come out and say, in the bill that didn't make it, they tried to come out and say, yeah, we kind of get it. That is kind of crazy. So we now want you, if there's $40,000 of capital gains and there's $200,000 of rental income, we want you to allocate that pass-through elective to the components of the income on that K-1. But it didn't pass. So to this day, your pass-through entity tax election is supposed to be an ordinary income deduction on line 1 of your K-1. Now, I get K-1s in my office where the practitioner puts it on the federal K-1 as a credit because they're too nervous to put it on line 1 where it goes, or they don't understand where it goes. And so then if we try to do it correctly, which I try to put it on the Schedule E and go, hey, no, I'm entitled to this, the client's entitled to this $18,000 deduction right here on Schedule E, then what happens? We might get a matching letter, right? But anyway, so if you're not familiar with PTT is supposed to go on a federal K-1, check that out in your little handout. Now, I want to scoot along to, also, if we have any passive credits. For example, somebody puts solar on a rental property. So that would be a tax credit related to a passive activity. So that credit is probably going to go through our 8582 if we put the credit in the correct place on our K-1 in our software. And then, so here's our energy credits that we talked about. And this I already mentioned, that our pass-through items for the S-Corp or the partnership, if they are eligible and they meet the QBI aggregations, the partners and shareholders are permitted to aggregate their investments in an entity with their other QBI activity if it benefits them. No SSTBs. We also have a little bit of information here. If you've got an oil and gas what they call a working interest in an oil and gas partnership. That, similar to the investment partnership, is statutorily non-passive, and you're allowed to take the entire deduction. Watch the state conformity. And by the way, watch the state conformity. In California, they came out just in 24 and said no. So up to 24, California conformed to that federal treatment of oil and gas losses for intangible drilling costs. They don't anymore. We also, for light reading, have an oil and gas audit technique guide, which I have not read. Now, here's where I want to get to the fun part. K-1s that are unique to partnership than partners, okay? So a general partner is generally a partner that's defined as liable for some of the debts of the partnership other than money they just loaned. They're authorized to act on behalf of the partner and sign contracts. They generally work more than 400 hours during the year, but there's exceptions to that. So there's that. This is and I think I mentioned this earlier, a hot topic for court cases. SE tax for people that are acting like general partners, but they still have limited partner on their K-1. So we need to be careful about that. And obviously it doesn't matter at all if the activity is for real estate rentals, because even if they do materially participate, it's not subject to SE tax, okay? And then, and again, if someone's a general partnership, their pass-through profits are subject to SE tax even if they do not materially participate. And then we've got some chief counsel advice and some other sites in your handout if you want to do a little more research on that. And again, this slide is all about self-employment tax for general partners. The IRS is really going after that in a big way. Now, what I want to talk about here is, so pension plans are the same for S-corps and partnerships, and a lot of people don't understand that. They think since I'm eligible to fund, for example, a 401k or a SEP with my Schedule C, I should be able to do it with my partnership earned income. That is not the case. For a partner who's getting earned income from a K-1, they actually can only, other than an IRA, they can fund an IRA, but other than an IRA, they can only participate in another type of retirement plan, such as a 401k or a SEP, based on a plan that is sponsored by the partnership. They cannot unilaterally say, gee, I have this $100,000 of self-employment income, I'm going to do a solo 401k. And a lot of people don't understand that, and they don't understand that frankly, it's a what do they call it, a dishonored transaction or something. You can't do a 401k based on that. The other thing that I want to comment is the unreimbursed partnership expenses. This is, most of our software, this is the creakiest stage. I feel like there's a boat like breaking out in the waves or saying, every time I take a step it creaks. So this is our software that lets us do the little worksheet for our unreimbursed partnership expenses. Now, this could be some of the interest expense we talked about if it was to invest in the activity. It could also be, we may have a partnership that, let's say that they have rental property or they have any type of a business, and they say, everybody's going to do their own home office, everybody's going to do their own, let's say their own, any travel, they're going to do their own auto expense, that type of thing. So that's where these expenses go. One comment I would make, if there is rental activity, let's say we've got a couple of partners and they've got rental activity, it says right in the Schedule E instructions, it says right in the instructions for rental property, the pub, if we've got somebody doing real estate activity and they do not have a bona fide home office, then it's commuting miles when they walk out their front door and head over to the apartment house, even if they materially participate and do all the handyman work and all the tenant management and everything else. So it's very important that if you've got some clients that have, and I don't do this for every one of my rental clients, but if I've got a rental client that's got property, let's say in a vacation area, 100 miles from the house or something, and I'm trying to protect mileage for either just a regular Schedule E rental or a partnership unreimbursed expenses, I will do a little home office. I don't care about the home office deduction at all. I'm trying to protect mileage. Sometimes I'll tell them, go buy a rickety little desk at a garage sale. I don't care where you get it. Push it up against the wall in the garage. The only thing in that desk, it's exclusive use for your managing your rental property. You've got all the warranties for your appliances. You've got your tenant contracts in there, and that's what's in there, okay? The only thing in that desk is related to either your partnership real estate activities or your personal Schedule E real estate activities. And all we're looking for is those little square footage. Take your $5 safe harbor for home office, because all you're trying to do is get on the unreimbursed line for a partner or on the Schedule E other expenses for a 1040. You're just trying to get bona fide home office, $15, whatever it is. We're not looking for the dollar amount of the home office. We're doing this to protect substantial mileage for certain clients. If I've got a client that owns a couple rental properties in their community, and when I meet with them, they go, oh, my miles are probably 120 miles for the year. I don't do a home office. I don't care. But if I have someone that's driving a substantial amount for rental activity, they get a little home office, assuming that they have taken the steps that I've asked them to do. Now, here's what I love about the unreimbursed partnership expense. Oh, by the way, people always ask me this. Do unreimbursed partnership expenses increase basis? Yes, they do. But the minute you deduct them, they decrease basis. So in case that's confusing you at all, those expenses, when they're incurred by the partner, absolutely increase their investment in the partnership. But the minute you deduct them on Schedule E, that's a deduction that's then going to decrease your basis. Now, we've also talked about the 754 election. Ryan mentioned that earlier, and I mentioned a little bit earlier too. We don't have time to do a deep dive on that today, but be aware, if we have someone who has inherited a share in a partnership. By the way, I'll say this. This blew my mind. I have a client who has a very large retail store in Old Town in San Diego County. And her husband passed away, and for years they had this business in a general partnership. And years, way before they were ever my client. And he had always talked to me about they were going to go S, and they never did. He died. Their inventory was almost $1 million retail. That blew my mind. Is it cost or is it retail? What's the step up, right? And so now she's got the business. And by the way, they had gotten it from her mother, so this business has actually been in her family for years and years. But anyway, the funny part is now she's going S. And I said, well, why not? You know, she got this fabulous step up when the husband died. And I said, your kids they're only going to get a stock step up. She's like, I don't care. I think an S sounds like a great idea. So she got her step up, and now she's going S. More power to her. But what killed me was, if you talk about real estate, you get a step up to the fair market value of the real estate. That's retail. What if there was a construction truck, okay, and it's in a partnership, and the blue book value of that truck is $20,000? That's the step up. So it was driving me crazy, all the research I had to do, because I thought, I'm going to jail if I take the step up on retail inventory. But that's the number. Is that crazy? It blew my mind. And it was an enormous step up. It freaked me out to do it, because I was like, oh my God. But they had a paper inventory they had taken within a month of death and the whole 9 yards. They had all the paperwork, and and I called Ryan, I called a bunch of people and went, do you think this is retail? Yeah, it drove me crazy. But anyway, so keep in mind, and what he said earlier is absolutely true. It's a good idea for our 1040 client to consider a 754 for them, and would it benefit them? The partnership does absolutely not have to do it unless they've ever done one and not revoked it. Once the partnership does it once, any subsequent transactions that would be eligible for 754, they've actually got to do up or down, by the way, step up or step down, unless they've had it revoked. But there's some partnerships that's literally in the partnership agreement. Let's say you've got, a rental partnership that's got 20 pieces of property and they've got 30 partners. They'll say right in the agreement, we're not doing any step ups, we don't feel like messing with it. Okay, so the basis gets a step up to that partner's pro rata share of the underlying assets, but what they're going to give up is their extra depreciation while they're in that partnership. Okay, so I'm going to scoot along through this, and then also qualified conservation easements. I don't want to talk a long time about that, but if you're not sure the IRS is going after qualified conservation easements, they split out, and I think they just did it in 23 or 24, contributions now on the 1065K1, cash and non-cash. Before that, it was just contributions. Now you've got to put in, gee, that's not cash, because they are going after conservation easements. Cancellation of debt is interesting, and we need to keep that in mind for partners and shareholders. I actually had to give somebody back their S-Corp K1 one year, and we got a new K1 back because the practitioner didn't understand the rules. What happens is a partnership that, let's say, gets cancellation of debt, they've kind of fallen on hard times and they've defaulted on some of their loans or whatever, okay? They can pass the cancellation of debt income out to the K1 recipient, and if the K1 recipient is insolvent, they can file the 982. However, the S-Corp cancellation of debt is at the S-Corp level. If the S-Corp is insolvent, you're good. But if the S-Corp doesn't meet the insolvency rules, that cancellation of debt income is going to flow to the shareholders. So that is a different. We also have some information on the publicly traded partnerships. If you're not familiar with how this works, it's basically that any losses from a publicly traded partnership are only allowed to be used against not only publicly traded partnerships, but only that publicly traded partnership. So that's why in our software we have to check the little box that it's a publicly traded partnership, because then our software knows that they can't like mix passive losses or any other goofy thing. And then I also stole from Ryan his cute little worksheets about tracking basis on publicly traded partnerships and his sale of publicly traded partnerships. I stole those right from Ryan a couple years ago. And so I have these little worksheets for you in there. So and we don't need to do it twice. He already did it. Okay, now, matters that are unique to S-Corp shareholders, not subject to SC tax. An S-Corp shareholder can only deduct health insurance that has been reported on their W-2. This is a classic gotcha by an S-Corp auditor. They come zipping on in. They see the health insurance on the 1120S or the P&L you gave them. They look right at the shareholder's W-2. If the health insurance is not right there in like box 14, 2%, blah, 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 and it hasn't increased box 1, that's the first adjustment they make on the S-Corp tax return. They take off the shareholder's health insurance. And again, we need to be thinking about this. If you've got a client coming into your office and they're giving you an S-Corp, for example, K1, and they're not giving you a W-2 from the same S-Corp perhaps, and you believe they're probably working there, you need to say, how are you getting health insurance? And if they go, oh yeah, the S-Corp pays our health insurance, okay, that's fine. That means the practitioner probably just took that insurance expense on the 1120S. If that S-Corp is audited, they're going to immediately throw out any health insurance for any shareholders or family members or grown children of shareholders, even if they're doing bona fide like regular big jobs there. So it's important as the 1040 practitioner, not only do we have to, and I love this one. I love it when they come in and they give me a K1 for like 200 grand, no W-2, and it's a construction firm or something. So we're already kind of used to kind of going, you're supposed to be taking wages here, but we also want to look for the W-2s. I have some clients that have enormous S-Corps, and a couple of them, it's actually kind of funny, and I'm like, I don't understand why your big, huge CPA firm isn't doing your 1040. Why am I still doing your 1040? And he's like, oh, they ask me all the time. I won't do it. It irritates them. And I'm like, okay. So some people just don't want the big CPA firm that runs them through, you know, whatever, all the hoops to get their big, huge S-Corp done, and they want to still use us or whatever, who knows. But I've had some enormous CPA firms where I've had to go back to, it's a lot of times they're doctors. And I'm like, I know for a fact you pay your health insurance through this S-Corp medical practice you're in because it's been on your W-2 the last 3 years. Where is it? And they've got to reissue the W-2s because the accountants literally did it wrong. So if you're getting K-1s from S-Corps and they're operating, they're working in those S-Corps, where's their W-2 and where's their health insurance? Now, sometimes they go, I'm getting health insurance for my wife's job. Okay, fine. That's fine, but we need to keep an eye on that. The other comment that I would make, and this one actually annoys me more, but somebody will give me, for example, a K1 from an S-Corp that's like negative 80 grand, and then they'll give me a W-2 for 50. I'm like, gee, somebody didn't do a lot of planning here. You wasted $7,500 here, and if you're a 50-50 partner, your firm, who lost a lot of money this year, wasted 15 grand on FICA because somebody didn't do a lot of planning. So again, as the 1040 practitioner, and by the way, if you want to build a business practice, just look for mistakes on the S-Corp K-1s you're getting. You might endure yourself to your client's partner, and you may get a new S-Corp client. You never know. But in any event, so those are some of the things. By the way, your software will let you do unreimbursed partnership expenses for your S-Corp K-1. It's not permitted. Your software will let you do it. And the reason your software will let you put things like auto expense and home office and all this stuff for an S-Corp K-1 is because they have to allow the little worksheet because you may have bona fide deductible interest expense for your S-Corp. But technically, if they're ever audited and they have unreimbursed shareholder expenses on Schedule E right out the door, those can only be your client's S-Corp expenses, out-of-pocket expenses, must be reimbursed by the S corporation and reduce their K-1. That's how that works. They're not, and your software will let you do it wrong. So and I see it all the time. So just be careful about that. As I love S corps, and again, generally speaking, they get the 20% QBI and they get the PTET, although there may be some limits to the SSTB. Now. Oh, by the way, you know what else was in that bill besides trying to split out the PTET? They wanted to say if you met the SSTB criteria for QBI, you couldn't do PTET at all, even without an AGI issue. They wanted to just say nobody that met the deal of the criteria of an SSTB under QBI could ever make a PTT election. That didn't pass either, thank heavens. Okay, so now what we've got is just some what I've already been kind of like ranting about a little bit, which is if they're receiving K-1s with substantial income and no W-2 and they have large losses and that kind of thing. Also, again, if you're trying to ramp up on business taxes, tell them you want the whole S-Corp tax return. If you get a K-1 from a partnership, tell your client you want that partnership tax return. You want the whole thing. You want Fed, you want New York, you want it all. They're great examples, and you sometimes find things you weren't aware of. And the other reason that I strongly suggest people get them is because you'll have a client that just settles for their little K-1 every year. And they're maybe a one-third owner in this enormous partnership. They're entitled to those records. And I think all my clients should get all of the full business returns every single year, whether I get them or not, I don't care. But anyway, so then as we mentioned, same with partnerships, an S-Corp shareholder may only participate, first they have to have earned income, which means they have to have a W-2 from their S-Corp, but they may also only participate in a 401k or SEP or any other type of plan that was sponsored by the S corporation. And we've already talked about the health insurance. Now, if you're not familiar with how that health insurance works, there's no payroll tax on that health insurance for the shareholder or the S corporation entity. How it works is, let's say you've got someone who has 12 employees, okay, plus let's say the 2 shareholders. And all the full-time employees get regular health insurance benefits. If part of those annual premiums paid by that S-Corp are for either or both of those shareholders, if it's not reported on those shareholders' W-2s, in the event of an audit, the examiner is absolutely positively going to disallow the health insurance expense for the amount of premiums paid for the shareholders and their family members. It is supposed to be reported on box 1 of their W-2, not box 3 or box 5, not subject to any even state or local payroll taxes. So what it does is, allowing the shareholder, allowing the shareholder's business deduction for health insurance on the 1120S lowers the profit. Then we're raising the K1, the W-2 only for income tax purposes, box 1. That's a wash. By doing it correctly, now that shareholder is eligible to take the self-employed health insurance deduction, the 7206, on their 1040. That's where they ultimately get the deduction. And by the way, if you have grown children related to the shareholders working in the business, The K-1 is reduced by the grown children's health insurance premiums. The kids' W-2 is raised by the benefit they got. And then the kid can take the SE health insurance. Ultimately, the shareholder gets the deduction because they don't get the reduction of the K-1. The grown child is just an employee of the firm. But they're not damaged by having their W-2 raised because they get to take the self-employed health insurance deduction too. So it creates a wash for the grown child that works for the shareholders that's getting their own family's health insurance benefits, and the shareholders ultimately get the full deduction as a business expense for the grown children's health insurance. So that's how that works. And then I've already talked about the S-Corp shareholder out-of-pocket expenses. I'm going to scoot here, and then we've talked about the 7203 and how we've already talked several times today about how the math on the 7203 works. I didn't spend a lot of time on the shareholder debt allocation, but some of the most critical things to keep in mind, for example, is no cosign debt and no intercompany debt would not survive an audit in that case. And then we've talked about correcting basis for S corporation shareholders. So, and I had mentioned this earlier, that remember the 7203, here's the line, 3M, or line 13, other increases to basis, other decreases to stock basis, and we have similar lines on the partnership basis worksheet in the instructions. We also have a tax advice memo where the IRS stated, their IRS counsel literally said, what if we become aware they have taken distributions in excess of basis in prior years? We're supposed to be kind of keeping a record of that in what they call a suspense account. And then as basis gets reinstated due to new earnings or new investments, we're supposed to chip away at that. You can decide your level of comfort whether you want to go back and track those things down. But we do have some guidance on years where losses have been taken in excess of basis and or distributions. This, I've already talked about that special ordering rule on the top of the 7203, where we talked about you can reverse that order if you want to. And then we've also talked about the fact that distributions are tax-free to the extent of beginning basis and current year income, regardless if there are other losses. And then this is the third bullet point here. That's the election I can never remember the number of, but it's under 1367-1 little g. That's the one where we can flip the order. And by the way, almost no one does this. It's very rare to see that election made. There may be some cases, for example, let's say you have somebody who's got a restaurant and they're going to have this big tips credit every year, so they're going to have this large amount of non-deductible payroll tax expense for, let's say, many years in a row. If you could time everything right and had them take the exact right amount of distributions every year, you could, in theory, get $20,000 or $30,000 of these non-deductible expenses just fall off and never have to be carried over ever again. But it takes so much work to get it right, and I've never seen anybody take the time to worry about it. Ryan went crazy during COVID to think about, were there a couple of years with these huge PPP loans, for example, and some the ERTC, where we had these huge amounts of non-deductible wages. Did we all miss this golden opportunity to get rid of a whole bunch of non-deductible expenses without reducing basis? But it was one of those things that it took so much work to set it up. Okay, and then here's the stock basis ordering rules, which we already chatted about. And then our treatment of suspended losses, and that example I've done, and we've also done it must be the shareholders' own funds for loan basis. I'll tell you what, we are out of time, and what is in the rest of your handout is what we talked about yesterday, which is the pass-through expenses on the trust K-1s. That's what we're not going to get to, I apologize. But that's what we talked about Sunday in our workshop. And yeah, here we go. We start our Trust K1. So I'm going to end here because we're out of time. I hope this was helpful. I know it's kind of all over the place. A lot of random facts, I guess. Trivia, tax trivia. Okay.